For years, the market held a clean mental model of CMC Markets. It was a retail CFD broker. It made money when markets moved violently. When volatility faded, so did earnings. That was the logic. That logic just ran into a problem. On the 4th of June, CMC reported pre-tax profit of £101.3 million. That is up 20% from £84.5 million the year prior. Net operating income rose 50% to £392.6 million. EBITDA grew 14% to £117.8 million. The shares surged 15.9% in a single session. That made CMC Markets the top riser in the entire FTSE 250 that day. But here is the question that 15.9% does not answer. Is this a re-rating, or is it a relief rally on a cyclical peak? That distinction is worth everything to a holder right now. The old model says CMC had a strong year because 2026 markets were volatile. The new data says something structurally different is being built inside this company. Both readings exist simultaneously. The market has not chosen between them yet.
The retail CFD business is real. It is still the core, but it is not the whole story anymore. The segment that is changing the revenue quality, read, is Australia. CMC's Australian stockbrokering operation generated $140.3 million in operating income. That converts to roughly £74.4 million. It grew 32% year-on-year. That is not a volatility spike. That is a client base and asset base compounding. Assets under administration in Australia rose alongside client activity. The driver, CMC's stockbrokering partnerships with Westpac Banking Corp and ASB Bank, both are on track to launch within the next 12 months. When they do, CMC will be embedding its infrastructure inside two major financial institutions. That is not a retail CFD model. That is a B2B distribution model. The institutional and B2B partnership segment is what management described as continuing to scale. Scaling is specific language. It implies recurring revenue, not event-driven revenue. The dividend confirms the directional confidence. CMC raised its annual dividend 21% to 13.8 pence per share. A company that views its profit as a one-off windfall does not raise its dividend by 21%. That signal is deliberate.
The FY 2026 result was strong, but the guidance is what caused the re-rating. CMC told the market to expect net operating income in FY 2027 of between £460 million and £480 million. That is at least a 17% increase from FY 2026's £392.6 million. It also sits above prior market consensus. That is the material part. The company is not confirming what analysts already expected. It is telling them their models were too low. The day after the results, Jefferies responded. Jefferies upgraded CMC Markets from hold to buy. The target price was raised from 275 pence to 500 pence. That is an 82% lift in the target, in one move. 500 pence against a share price of 426 pence after the results day surge. That implies a further 17% upside from an already elevated level. Two questions sit inside that upgrade. First, if consensus was below management guidance before the results, why? The answer is the old model. Analysts priced CMC as a volatility-dependent business. They applied a haircut to management's own confidence because they did not trust the institutional thesis. Second, does the Jefferies upgrade close that credibility gap, or does it open a new one? The hidden assumption Jefferies is making is that B2B institutional income has lower churn than retail CFD. If that assumption holds, the 460 to 480 million target may itself be conservative. If retail CFD normalizes faster than B2B ramps, the model breaks in the other direction.
There are two groups holding CMC Markets right now, and they are reading the same data differently. Group 1 sees a cyclical peak. Markets in FY 2026 were described by management itself as a period of extreme volatility. This group assumes FY 2027 guidance bakes in some normalization risk that has not been disclosed. They are watching for the first quarterly signal of softening retail activity. Group 2 sees a structural inflection. The institutional and B2B segment is not correlated to retail volatility in the way the old model assumed.
The Australian stockbroking business is growing its assets under administration regardless of market conditions. The Westpac and ASB bank launches represent embedded, sticky, recurring distribution. This group reads the FY 2027 guidance as the floor, not the ceiling. These two readings cannot coexist indefinitely. The checkpoint that resolves them is the Westpac and ASB bank launch timeline. Management said both partnerships are on track to launch within 12 months. If they go live on schedule and B2B income begins to show up in H1 FY 2027 updates, Group 2 wins. If the launches slip, or if retail CFD income softens faster than the B2B income ramps, Group 1 is vindicated. There is one more structural question worth holding. If institutional and B2B income grows as a share of total revenue, what happens to CMC's market sensitivity? A company that earns recurring B2B platform fees does not carry the same sensitivity profile as a pure CFD operator. If the revenue mix shifts materially, the 15.9% single session surge may not be the re-rating. It may be the beginning of a multi-year valuation reset. That is the bet Jefferies just put £500 on. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.